While everyone's been glued to volatile crypto charts, the world's biggest banks have been quietly rebuilding the global financial system right under our noses. Right now, hundreds of billions of dollars are shifting onto public blockchains. And the craziest part? It's completely legal, fully rated, and happening faster than anyone realized. There's a silent war going on for the future of your money, and it literally has absolutely nothing to do with Bitcoin. The world's largest banking institutions are actively tearing out traditional financial plumbing and replacing it entirely with public ledger technology. Look at the sheer scale of this. As of May 2026, the on-chain value of tokenized real-world assets has just exploded, hitting a staggering $33.84 billion. That's a massive, massive jump from the $5.4 billion base we were sitting at just a year prior. Giant institutions, we're talking BlackRock, JPMorgan, Fidelity, they aren't just running little closed laboratory experiments anymore. They are actively deploying massive capital pools out in the open on public smart contract networks, creating a total structural transformation of global capital markets.
But here's the kicker, the hidden layer of the market that almost every casual observer is completely missing. If you actually factor in the unrepresented asset value, so the underlying physical properties, the private credit, the securitized collateral that's managed off-chain but administered through these networks, that total footprint skyrockets to nearly $230 billion. And this system is actively serving over 822,000 unique asset holders worldwide.
And the math completely backs this up. This is not some passing retail hype cycle. What we are looking at is the mathematical proof of a historic institutional capital migration. It is a highly calculated, structural reallocation of capital, and it's being driven by the world's absolute largest asset managers. What's absolutely wild here is the velocity of the shift. We are looking at a compounded annualized growth rate soaring past 250% over a mere 17-month window. Think about that. Trillion-dollar players are actively shifting their core infrastructure onto the public stage for one simple reason. They are chasing unprecedented capital efficiency. But dragging this much institutional money into the public square has exposed a massive, glaring technical vulnerability.
So the original promise of public blockchains was this beautiful 0-to-1 paradigm shift, right? One unified layer for flawless global distribution and automated compliance. But the brutal reality? Major institutions are deploying across a bunch of competing public chains, Ethereum, Solana, Avalanche, trying to capture different markets, and instead of unified efficiency, they've accidentally created severe network fragmentation.
And that fragmentation has a massive real-world cost. Moving capital between these isolated competing networks isn't exactly seamless. In fact, it drags a hefty average of $36 per transaction in fees and slippage. Now, $36 might sound like a minor operational cost on paper, but you have to imagine scaling that friction across a multi-billion-dollar asset base that's executing thousands and thousands of trades every single day.
Which leads us to this staggering contradiction. This supposedly perfect, hyper-efficient blockchain ecosystem is actually bleeding anywhere from $600 million to $1.3 billion right out of the market every single year. It's an enormous value leak. Developers are out there desperately trying to patch it up with unproven interoperability layers and cross-chain messaging protocols. But it leaves us with a massive open question. Can they actually secure these multi-chain bridges, or are they literally just building a bigger $1.3 billion target for hackers to exploit?
So you might be wondering, why the sudden aggressive institutional rush if the underlying tech is bleeding that much money? Well, to understand that, we have to look at Washington. This wasn't some random market trend. It was sparked by a massive legislative shift. The 2025 Genius Act came in and established a strict federal regulatory framework for digital stablecoins. It restricted stablecoin issuance to heavily regulated entities and mandated incredibly strict one-to-one liquid asset reserves.
But tucked deep inside that legislation is a hidden catalyst. The law includes a yield prohibition clause. It explicitly prevents stablecoin issuers from paying interest directly to everyday retail holders. Now, this wasn't done out of malice. It was actually a protective measure, specifically designed to prevent a rapid, devastating flight of deposits away from local community banks into these higher-yielding stablecoins.
But as is so often the case, there were unintended consequences. That prohibition accidentally birthed a gigantic capital pool of non-interest-bearing float. Because stablecoin issuers are legally mandated to back their tokens one-to-one with high-quality liquid assets, like short-term U.S. government debt, they suddenly had to find a place to park trillions of dollars to capture yield on-chain. And that specific legal quirk, it triggered an absolute institutional gold rush.
Because of that, there is an absolute heavyweight fight breaking out right now for total dominance over this massive liquidity pool. Circle and Hashnote's USC product currently sits at a massive $3.0 billion, taking the crown as the largest tokenized treasury product on-chain. But right on their heels is BlackRock's BUIDL fund at $2.58 billion, and Franklin Templeton's Benji suite pulling in roughly $1.98 billion. What's really fascinating, though, is the massive divide in who actually gets to play in this sandbox. On one hand, you've got BlackRock essentially putting up velvet ropes, demanding a strict $5 million minimum ticket size aimed squarely at ultra-wealthy, qualified purchasers. But on the exact opposite end, Franklin Templeton is completely democratized access. They're letting everyday retail investors buy into these institutional-grade government funds directly through a mobile app for a minimum investment of just $20.
Now, it hasn't just been a smooth ride up. This transition is incredibly sensitive to market forces. Between late 2025 and early 2026, BlackRock's massive BUIDL fund experienced a net capital outflow of approximately $1.1 billion across multiple chains. It's a stark reminder that institutional capital is highly reactive. It will absolutely flee at the first sign of environmental shifts or multi-chain vulnerabilities.
But despite that volatility, we just witnessed the ultimate institutional checkmate. See, for years, conservative corporate treasurers and pension fund managers couldn't touch these assets because of internal risk mandates. They just weren't allowed to. But that barrier completely shattered when Moody's Ratings officially assigned its absolute highest credit rating, AAA-MF, to on-chain funds like Butyl and Fidelity's PhilQ. This was the exact moment risk-averse institutions were officially handed the green light to treat these digital tokens as direct equivalents to physical cold hard cash.
But here's the mind-bending reality behind that AAA rating. As Moody's explicitly pointed out, the legal ownership framework operates completely independently of the blockchain ledger itself. Meaning, the true safety net? It's not the decentralized cryptographic blockchain at all. It's the traditional, conventional legal registries backing it up behind the scenes. If a smart contract gets exploited or a network literally goes dark, your rights are still fully protected by the legacy system.
And that realization brings us to a massively high-stakes conflict over the very future of corporate cash. You've got bank-issued tokenized deposits boasting massive structural advantages. They are backed by balance sheet capital, they have pass-through deposit insurance, and built-in compliance. They are going head-to-head against non-bank stablecoins, which offer absolutely zero FDIC insurance and function essentially as bearer instruments. Traditional banks are quietly building an impenetrable regulatory moat. So, where is this massive structural realignment heading next? We are staring down a multi-trillion-dollar horizon. Competing growth projections point to an absolute from-the-ground-up overhaul of global financial infrastructure. McKinsey is forecasting a conservative $2.0 trillion baseline by 2030, while Standard Chartered projects an eye-watering $30.1 trillion demand-driven market. And to capture that scale, universal interoperability layers are currently in a dead sprint to eliminate that $1.3 billion multi-chain friction we talked about earlier.
The reality we're facing now is that the old dividing line between traditional finance and decentralized tech, it hasn't just blurred. It is completely, entirely dissolved into a single, continuous, 24/7 global financial network. The boring back-office plumbing of Wall Street legacy systems and cutting-edge public ledger technology are now completely indistinguishable from one another.
And that leaves us with a fascinating, unresolved tension. As trillions of dollars in traditional banking legally shift onto public blockchains, who do you think really controls the future of your money? Is it the decentralized tech network processing the transaction, or the legacy legal registry quietly backing it all up behind the scenes? Drop your thoughts down in the comments. I want to hear what you guys think about this one.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.